When you listen to any of the Wall Street strategists this year, it sounds like 2023 looks pretty bleak. From an investor's point of view, does it look as bad as what they're saying?
It looks tough, but look, most years look tough. This year looks very tough, especially for equities. I can't tell you how much more downside I think there is to equities, but it's very hard to see a lot of upside. It does feel like the markets are pricing in a more benign set of moves by the Fed than I think what many of us believe is actually going to happen. And that, of course, becomes very tough for equities. And so we remain very cautious, very defensive in terms of our own positioning vis-a-vis equities, by no means out of them. But as I've told you, I think in my last couple times on your show, still at essentially as defensive a position as we've ever been in our 14 or so years of existence.
Well, I want to talk about the defensive position and what that constitutes. But when it comes to equities specifically, Steve, you have said in the past, given the discount rate, if nothing else, basically when the rates are rising, that's not good for equities. But does your position on equities for 2023 tell us something about where you think that the Fed will be throughout the year, and for that matter, where inflation is going to be?
Well, it tells you something about where we think they're going to be. Of course, I have no idea, and they have no idea. In fairness, there is no, as you know, there is no secret Fed plan that the media is trying to get hold of. It's all data dependent, data driven, as Janet Yellen used to say. But the fact is that the credit markets, from which the equity markets take their cue on Fed policy, are looking for interest rates to peak somewhere in the early first half of next year and then begin to decline. And I don't believe that that is what the Fed is likely going to have to do or will be doing, because I don't believe inflation is going to come down enough for them to do that. And so if you believe not necessarily that interest rates will go higher than the markets think, but at the very least that they will persist at high levels for longer than the market thinks, then you have to be nervous about equities.
Equities, of course, are not all created equal. Some are much more sensitive to the discount rate than others. Does that suggest that there might be some defensive positions in equities, actually?
Yes, that is absolutely true. The growth equities, the unprofitable tech, all that stuff is certainly more susceptible to high interest rates. But then you have a bunch of cyclical stocks, which also can be called sometimes value stocks, that are sensitive to economic conditions. And the yin and the yang of all this is that we still are facing the probability of a recession, maybe the back half of this year, 2023, maybe early in 2024, and that's not good for cyclical stocks. And so, sure, there are always some places, some pieces and places that one can go, but overall, it still looks like a pretty tough market.
So what about fixed income? I hear at least some people saying this may be the year of the bond. Maybe the bonds are coming back, yields will come down. Are you more comfortable in fixed income?
Certain parts of it, and in the following sense. Given our view about interest rates, it is hard to be constructive about fixed rate, fixed income, if you will, bonds that have a fixed coupon on them, because they are also going to be susceptible to rates staying higher for longer. Where there is a very interesting opportunity at the moment, we believe, is in what we'll call private credit. What's happening out there is the banks are very reticent to lend, especially for leveraged transactions and things like that. They still have a lot of hung loans on their balance sheets. They see the same world that we all see. And so they're pretty, I wouldn't say out of business, but reticent to lend. The high yield market has been essentially closed now for the best part of a year. No real sign of that opening. So what's happening is that you have a number of firms, private firms, or private credit-oriented firms, I should say, that are finding places to put money to work at very attractive spreads above LIBOR or SOFR, whatever you want to call the current benchmark interest rate. And so you not only won't suffer if rates go up, you actually benefit if rates go up. And you're looking at this paper coming at spreads in the 650, 700 basis points even over the Treasury or the SOFR rate. And for stuff that is really first lien, secured, top of the capital structure kinds of opportunities. So you can make 10, 11, 12% on that. And to us, that seems like a very good trade relative to what's likely to happen to the equity markets at the moment.
Steve, as you look at 2023, what about geography? Are there places that you see that are relatively better suited to what you need to get done? Are there places like, I'll name some, India, Southeast Asia, Indonesia, places like that?
Well, first, the U.S. always, I shouldn't say always, the U.S. has for some time now been and continues to be the best house in a bad neighborhood on a risk-adjusted basis. As you look around the world, and I'll get to some of those slightly more far-flung places that you mentioned, but as you look around the world, Europe has clearly got a set of economic challenges, even with energy prices coming down. It's possible Europe could perform well simply because the markets are relatively cheap, but in terms of fundamentals of growth, it doesn't seem very attractive to us. China obviously is an opportunity, but one that is filled with risks, and alligators and crocodiles are on every corner. I was in India just before the Christmas holidays, and India is actually finally looking like it may be more interesting. It's always been a market waiting to excite and impress people, and often not doing that. It does feel at the moment like India really is starting to move forward for a whole variety of reasons, including China moving back. And so India is interesting on a number of levels. And then Southeast Asia, you really have to go country by country. It's not our area of expertise. We don't really do anything there. Indonesia is potentially interesting, but I have not spent time there, so I'm not an expert on that.
Steve, when you say you're as defensive as you've been, maybe ever, but certainly in a good long time, does that include making sure you have a lot of liquidity? Does that mean you stay in cash or cash equivalents because you think there may be opportunities as the year unfolds?
Yes. First, we are as defensive as we've been at any point in our 14 or 15 years of history. And that does include a lot of cash. And it's not that we necessarily want to get ready to pounce on something, although it does put us in the position to be able to. But you really can't lose money holding cash. And especially with short rates having moved up so much, you can actually make a decent amount of money on relatively short rates. You can buy 2-year Treasury paper and make over 4%. It's all a lot better than potentially risking money in the equity markets at this moment. And then we do other things involving hedges and things like that to make sure hedge funds, hedges, to make sure our equity exposure, our exposure to the equity market, I should put it that way, is down where we want it to be. And as I said, look, we're still very exposed to equities. We have too big of a battleship to pivot that quickly, even if we wanted to, and none of us can be sure we're right. And so we do want to maintain a healthy exposure to the equity markets. In the long run, we believe in equities, and we try not to be short-term traders or market timers, but we do feel, and so far, for better or for worse, it's been the right call, that we want to be on the defensive side of the range of possible positionings we might have.